You are listening to ChartingWealth.com's daily review for the day, beginning Friday, the 29th of January, 2016. Where do we always start? IYY. What is that? That is an ETF that reflects the total market, all the stocks. What do we see going on? Well, we have a rising market. And again, over the last three candlesticks, once we broke our two-day trend line, the last 6 days being reflected here, actually 5 because we will close out the last two-day candle on Friday the 29th. But what do you see going on? Well, we see a market that is really slipping sideways. It was up back on the 25th, that two-day candle, down on the 27th, and up again as far as the first half of the two-day candle goes on the 28th. We'll see how what the 29th holds. However, over those 6 days, the market has not closed above where it began going down on the 21st. So what's that telling you? Not much of a rise at all. However, the MACD is getting closer. It's not crossed over going up yet on the two-day chart. That's the moving average convergence divergence indicator. And the derivative oscillator is losing speed. Is this an extended dead cat bounce? A very slow one? And is it going to roll back over or not? Well, to sort of get a better feel for what might be happening, let's revert back from our two-day chart to our 4-hour chart, our smaller chart. What do we see going on there? We saw a crossover going up on the 21st. The market chugged up for a couple of days. And what has it done since the afternoon of the 22nd? That would be last Friday. It has pretty much slid sideways. And where is it going at this point? Well, if you look at the prices as far as the candlesticks goes, looks like you've got a down pattern forming here. And again, this is the Hinki Ayashi. Even though the market was technically up 0.38%, so about a third of 1%, the Hinki Ayashi, which is what I love so much about it, and you can look that up, Heikien, Ashi, A-S-H-I. You can also study the candlesticks and how the patterns work at our website, Charting Wealth, but you can also look up the Hinki Ayashi in just Wikipedia or on Google and read about it also. I like it because it's not regular candlesticks, opening, close, high, low. It's rigged differently and it gives you a different perspective. The perspective it's giving you is downward movement as far as how those patterns show. Now, what do we see happening though? We don't see yet a closure of the MACD. Derivative oscillator continues to lose speed, but the MACD has not crossed over going down yet. That would be the blue MACD crossing over the red signal line going down. That's not happened yet. We're still watching and waiting to see if that occurs, because if it does occur, then we do have a dead cat bounce and the market's rolling back over. Another interesting thing to watch is how the Bollinger Bands are getting closer together as volatility decreases because of the sideways slipping market. It also makes our MACD indicator not as predictable because the MACD doesn't work well in a sideways slipping market. You don't have that much of a moving average converging and diverging. That's what MACD means, of course. If you don't have that convergence or divergence because it's slipping sideways, you don't have as reliable an indicator as the MACD typically is. But we do see our derivative oscillators losing speed as the candles are going down, which again may be pointing at the dead cat bounce we've been talking about in the market rolling over. Not seen that yet, not talking about making any virtual trades yet. We're just talking about watching, waiting, listening, learning, doing the right things. Now, let's go back to our two-day chart. And let's go to SPY. What is SPY? The Standard & Poor's 500. It looks very similar to what we saw on the IYY, the total market Y. Well, the SPY reflects 500 of the big stocks in the market, a lot of the volume. It is a little different. And in fact, as those of you who are viewing this, those listening, I'll tell you, same thing where the market started going down on the 21st on that two-day candle, still has not hit that height on the last 6 days, or really 5 days. Now, technically, SPY was up 0.5%, just a little over 0.52% for the day. Now, if we revert back to our 4-hour chart, we see a chart that looks quite similar to what we saw with IYY. The last 3 candles, red going down slowly, slipping sideways and moving down. MACD is not yet crossed over going down. Derivative oscillators lost a lot of its energy. And if we see the derivative oscillator and the MACD crossover going down at the same time, bingo, that is what we like to see. And we'll see if that happens. If so, we know that an inverse trade on SPY is what you're looking for. That is another fund that's an inverse of the SPY. And again, we're not talking about doing real money trades here. We're all about training. Once you learn enough and know enough, you can then use your own knowledge to make trades. We're not a stock calling service. We try to remind you that of every episode and every disclaimer on our website. Now, lastly, we're going to revert back out. When I say lastly, I'm only talking about lastly for our indexes because we still have gold after this. We're going to go to the Qs on the 2-day chart. What is the Qs doing? Well, the Qs was technically up on the 2-day chart, for the day, 1.41%. But when you look at the candlesticks, you see a very interesting pattern. It's almost, well, it is a doji of sorts. The cross is very high, which means there had been a lot of down movement pushed up by the bulls, pulled down by the bears. Again, it is a type of doji, lots of indecision there as the market has slipped sideways over the last 6 days or so. If we revert to the 4-hour half-day chart, we see an interesting pattern. We have basically 2 days worth of down movement, although the market ended up in the afternoon a little up. It has gotten closer to crossing over. Derivative oscillators almost zeroed out. That's very fascinating, although the MACD is not yet crossed over. So we'll continue to watch as we go into Friday's market as to what's going to happen with the Qs, or the NASDAQ 100, which is the technology stocks. Now, lastly, we're going to range out to our 2-day chart, and we're going to check out gold. What has gold done? Gold was down 1.07% for the day. Gold is still in an uptrend on the 2-day chart since it crossed over going up back on the 14th. And if we revert to our 4-hour chart, let's see what it's telling us. Well, the 4-hour chart's not yet crossed over going down, but it sure looks like it's heading in that direction. And it also looks like the derivative oscillator, well, it is losing a lot of speed. Not yet crossed over going down, but we like to see that 4-hour chart being accurate for us. It's been accurate on this last move. And as long as we can keep the market moving in one direction or the other, up or down, that MACD on the 4-hour chart may be a very good indicator for us. Well, friends, that is where the market has ended the day, both on our 3 indexes, the total market, Standard & Poor's 500, and the NASDAQ 100, and where we are on gold. Hope that you found this helpful. If you have questions, comments, concerns, we love to hear from you at chartingwealth.com. You can also visit us on Facebook, Twitter, Instagram, YouTube, you name it, we are there. And we appreciate you being with us. If you're not already signed up for our newsletter to get these reports every day in your email, do it. All you got to do is go to chartingwealth.com, sign right up there on the front page. What you'll get for doing that is you will get a charting layout, the charting layout that we use at freestockcharts.com. You'll have it for free. In addition to that, you'll get the link to our How to Read a Stock Chart video, which is just what you need to jump into the middle of not listening to the noise, but following the market, following the charts, which is the smart man's way of learning how to trade and invest. Thanks so much from chartingwealth.com.